And this is Real Estate Underground.
Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews with the Real Estate Underground. Thank you so much for making us a part of your day. If you are getting value out of our podcasts, I would love to hear from you, but also make sure that you follow us so that you get notified when we have new episodes. With me today is John Azar. He's with Peak 15 Capital. We discovered John at a conference that we were going to attend and unfortunately couldn't. Fortunately, he was kind enough to join us here on the show so I can pick his brain directly instead. So John, welcome to the show and thanks for joining us.
Thanks so much, Ed. Appreciate you. Thanks for having me.
Absolutely. John, you've had a really interesting career. I'm going to let you tell your story. Why don't you introduce yourself to the folks that don't know about you and then we'll get into it.
Yeah, sure. Really quick. John Azar. I'm founder and CEO of Peak 15 Capital. We're a private equity shop based in Charlotte, North Carolina. We have an office in LA. We have national coverage. We work with sponsors, operators, developers to provide them liquidity solution for their deals. Both from our fund, we are fund manager. So we run a fund that invests directly with sponsors and developers and operators on the GP side. And then we bring alongside of us one of our institutional programmatic partners. We have a stable of about 15 or 20 really tight institutional partners that we bring alongside of us on our deals. And we help fund their entire capital stack. We fund the equity stack, both the GP equity and the LP equity.
Gotcha.
Been in commercial real estate since 2005. Peak 15 Capital is my third in the space and launched it in middle of the pandemic in 2020 after starting to sunset previous portfolio that my brother and I ran here in the Southeast, concentrating on just multifamily, mostly value add. We transacted a few thousand units between 2013 and 2020 pretty actively, then started sunsetting a portion of that portfolio. We still have the joint portfolio together, but started sunsetting that portion in 2020 and launched Peak 15 in 2020.
So let me ask you, what were you seeing in the marketplace that was changing in the 1920 range that made you think that it was time to move on?
It's both. It's a combination of kind of luck, foresight, and a little bit of strategic planning. I don't think we set out and saying, yeah, we have a crystal ball and we know exactly what's going to transpire. If we had the crystal ball, we probably would have held on for another couple of years with some of the assets and sold in 2022 during the frenzy. But still, we were transacting at a really great time. And 2020 just seemed to be at the right opportune time after the pandemic started. We had different visions on what we wanted to continue to do. My brother's older than I am. He wanted to take some chips off the table. I wanted to not ease up. So we launched Peak 15 at that time. It was a combination of just timing and opportunity and strategic thinking.
Yeah. I mean, it's interesting when you start to make those transitions, it's a little bit of luck. Me, I would have taken credit for being prescient, but hey, I appreciate your integrity.
Yeah, I wish I can take the credit for being a Nostradamus on this, but I'm not. Obviously, we study the market on a regular basis and we try to do some strategically picking out our choices, predictions and analysis, but sometimes stabbing in the dark at some point or another.
Of course. I mean, they're managed risks, right?
If you prepare right, even your stabs in the darks could still be okay and not as bad.
So let's talk about what you're seeing in the marketplace these days. I think you alluded to the fact that multifamily has been a big part of your portfolio. Did I hear right, or did I infer correctly that you're also looking at other asset classes these days?
Yeah, our fund here at Peak 15, we are asset type agnostic to a large extent. There's a couple of type of assets that we are going to add in our next fund that our current fund does not have. We don't currently cover student housing and senior living and self-storage, which are 3 areas in commercial office, which are 4 areas that we will likely cover in our next fund that's launching in Q2 of next year. With this current fund that we have multifamily value add, we have ground up development, we have BTR, BTS, built to sell communities. We have a portfolio of car washes in our portfolio right now. We have a variety of assets and we are looking at industrial, flex industrial as well. In this fund, next fund, we'll have, like I said, more asset diversification than this fund.
So it's interesting. Are you primarily working with operators, known operators that you've built relationships with over the years in the various asset groups and letting them do what they do? Or can you walk me through your business model?
It is a broad approach, but there is a method to the madness, as there always is. The method to the madness is, yes, we work with identifiable, trusted operators, sponsors developers that we've known for years. And if we don't know them, we do very heavy due diligence on them before we invest with them. The method to the madness is that we are an alpha-driven fund for our investors. So if you're an alpha-driven fund, that means you have a fiduciary duty to deliver results and profits to your investors. And those results and profits may not always come from, middle of the fairway multifamily assets.
Sure.
There are a lot of funds out there that just really stick to their investing parameters of multifamily, and even very specifically a different kinds of specific type of multifamily.
Right.
We're contrarian in that viewpoints. We don't believe that is going to be the best utilization of our funds in order for us to get the biggest not just the biggest profits, but also cash flow for our investors. So there's a balance of cash flow and profits that you always have to, as a fund manager, you have to be aware of. Some of the projects that you're going to buy are going to be great for cash flow. Other projects you're going to buy or invest in are going to be great for future profits. Our development deals that we're investing in with developers are going to be great profit generators for the future.
Sure.
They're not going to be so much for cash flow. Value add assets that are well managed and hopefully profitable are going to generate some cash flow. Same story with our car washes. Heck, our car washes generate probably the highest amount of cash flow, more than I can ever duplicate from any multifamily holding we have. Yeah. So there's the method to the madness is when you're alpha driven, it means you have to go after results. And in order for you to deliver those results, you got to be comfortable a certain amount of diversification in your portfolio. As long as you are prepared and have the capacity to effectively analyze, underwrite those deals, and understand the mechanics, understand the entry, understand the exit, understand the assumptions really well, you would be doing your investors a disfavor if you don't have the kind of diversification, if you're calling yourself an alpha fund, which is what we are. So that's the long and short of it.
Yeah, it's been a very dynamic few years in this from a broad perspective, this industry, and taking what the market gives is actually prudent, is really interesting. When you said car washes, I fully expected laundromats to be in there as well, right?
No. So the only requirement is that we have to have a real estate play, a real asset behind everything we buy. And the car washes that we invest in are with land. So they are not just the operating company, but they're also the land value itself. That's going to be an important aspect to us.
Yeah. So laundromats, the only way that we own them is if we own the building too. So they're usually standalones as opposed to strip mall plays. But yeah, I mean, it's an interesting balance, right? Because you have development projects that aren't going to deliver cash flow for years. And then if you're an alpha driven fund, your investors are expecting a monthly or quarterly dividend in some cases, I assume. And the balance of cash flowing assets versus long-term plays has got to be very challenging. Especially in the market.
Yeah. They're expecting growth of their money. And for us to deliver the multiplier effect on their money that we've projected on everything we buy. So that's what they're expecting. The cash flow is there, but it's not the main concentration. The main concentration is the profit, because in this business, you make your money on liquidity events. That's where we make our real money. 6 to 10% is not going to make anybody rich. It's nice mailbox money, but that's not generational wealth money. Your generational wealth money comes from the liquidity events that you're going to have, even on stabilized assets.
In terms of the assets, a couple of them jumped out at me that were really interesting, and selfishly, I've been looking at as well. Light industrial and flex space being one of them. I've got a partner up in Boston, and that's his play. That's what Brian's doing. And he sent me a deal, it was probably 3 months ago, and I went through it. I'm an Irishman, right? So the way my brain's wired is I see mushroom clouds on the horizon first. And then I figure out, okay, how do we manage that? And the first pass on that, I was like, why are you doing this? And I was trying to understand. The deeper I got into it, the more people I talked about, I got really excited about it because it's a very interesting space. It's a rapidly growing space. And it seems like institutional buyers are really interested in this kind of space. Now, and I think I'd like your opinion on why that is occurring. What are the market dynamics that are pushing growth in that particular space?
Yeah, the flex industrial in particular is really interesting to us. And it's the same. That's why it's appealing to a lot of institutional investors as well. Not large scale, because they want the big box industrial, not necessarily the flex small industrial. The flex small industrial is really interesting to us because it operates almost the same way a multifamily asset. You're diversified in your risk approach. When you look at a flex industrial, you look at a building that has, let's call it 50,000 square feet, or maybe 100,000 square feet, or maybe 500,000 square feet, but you have 10, 15, 20 tenants, 30 tenants in the building that you have to contend with. So if you lose one or two, yeah, it might take you a couple of months to replace them, but you're not losing your entire cash flow. If you have a gigantic, one of those big box industrial, which are becoming less and less appealing to us, because of the onslaught of a lot of the big corporations like the Amazons and all that. That's great for them, but they hold the power. They hold the power. They can come in and tell you, I'm going to pay this, and that's what you're going to take, and that's it. And then if you lose one of those tenants, God forbid, you're screwed. You got to replace one tenant to take over 200,000 square feet of space. And that not a whole lot of, there's a very finite amount of clients that are going to be taking that type of the space from you. So therefore, that's why the flex industrial have become a real attraction to us and has become very popular among a lot of our investment circles for that exact approach. Diversification of tenancies, easier to manage and underwrite, because you underwrite it again the same way as you would underwrite, very similar to how you would underwrite multifamily.
I know.
If you're used to underwriting multifamily. Or self-storage, very similar to that to some extent. You got to be aware of what the market is. It's very market-driven, obviously, very neighborhood-driven, especially if it's newer. The newer product in flex industrial is very attractive. Older product, not so much, because you got to pay attention also to ceiling heights and bay doors heights and who are you able to fit in those, and what kind of retrofits are you going to be able to offer your tenants. You have to take all of those in consideration when you're looking at flex industrial.
Yeah, right on. It's one of the things that we've been looking at is the contractors. They're the two spaces that we're actually looking at right now, either prospectively or inhabited predominantly by plumbers, electricians, general contractors, and entities that need to store their materials. They try and buy in bulk, at least the stuff that they usually use regularly. A lot of these spaces that I've seen and we're looking at have office space up front, like 400, 500, 600 square feet of office space to operate from as well. So it's an interesting play. And I wholeheartedly agree. I think it's got the positives of multifamily in terms of demand, in terms of rent growth, in terms of opportunity. You can diversify. Dealing with commercial tenants is usually easier than dealing with residents.
Yeah, especially if you're doing triple net leases. Exactly. Very easy maintenance from a management standpoint.
Keep the water running, keep the lights on, keep everything connected, plow the road.
And keep the roof starting doing well.
And in terms of, I want to go back to car washes just because I'm intrigued. In terms of your view on car washes, obviously a huge cash flow play, but an appreciation play as well. Can you step me through that?
You said appreciation play?
Correct.
Oh, sorry. I don't know.
Yeah, we can edit this out.
Can you hear me now?
Yes.
Okay, perfect.
No problem.
Yes, there is an appreciation play, of course. It may not be as meaty a multifamily or like a ground up development, but the appreciation play is there. It is a little bit more conservative. You buy a flex industrial space. Are you going to sell it for double what you bought it for? Probably not. It depends on the area. Anything's possible. But in general, you're not underwriting to those standards. You're not underwriting that you're going to make 100% of you're going to sell it double, or you're going to sell it for 50%. But there is an appreciation play, especially if the area is up and coming. It's all about that's why it's really important for you to do a geographic deep dive and what's around, who's coming. The same thing with anything in real estate.
Get ahead of the path of progress.
That's exactly right. You have to understand who is coming here. What are they doing? What is the area going to look like as opposed to what it looks like now? Who is it going to be appealing for in 5 years or 4 years or 3 years? But that's the golden rule with anything you buy. That's not just industrial. The same thing with multifamily. You always have to think of your exit. I always tell people, you got to think of who is going to buy this from you. What is the profile of the buyer in 3 years or 4 years or 5 years?
Yeah.
If you can narrow down the profile of that buyer in 3 to 4 years, you're going to do a better job in underwriting the deal now, because you're just really reverse engineering the process. If you're saying to yourself, in 5 years, I want some big box or big corporation or a hedge fund to come and buy my asset, what are they going to be looking for in 5 years in this area to buy your asset and give you the profit you want? And can you deliver that next 3 to 4 to 5 years while you're holding this asset?
So Stephen Covey was right. Start with the end in mind. The fact is that it's really hard to run a business operation when your plan is without target. You're going to miss. There's no way you can hit a target you haven't defined.
That's right. You're absolutely right. If you have a target, you can't just, one of my favorite books it's called Hope Without a Method. Hope is not a method. And it's not just a book for me. It's a lifestyle for me. It's how we conduct our business. It's actually the company motto for us. And it's something I drill in the head of everybody that works for us is, don't tell me I hope this,
right?
And then tell me something about a business plan or numbers or underwriting. Don't ever start that sentence with I hope.
Right.
Tell me why you have these numbers. What are the definitions of why you're delivering these projections? Let's plan accordingly. Let's put together the right pieces of the puzzle in place. So this way you're not relying on hope, because that's not a strategy.
One of the things that we were talking about offline is your focus on helping other investors get into your space. I understand you have a course that you're launching, and along with a boot camp coming up in a month.
Yeah, we're launching. It's been a long time coming. So we used to have a coaching program that we cut out a couple of years ago because we are deal guys, not coaches. We wanted to concentrate more on the business and do more deals as opposed to coach. But I've always had a penchant for mentoring, teaching, and coaching. In order for us to balance best of both worlds, we put together this amazing course that we're launching in September. We're doing the launch via a 3-day boot camp that we're also going to announce on social media soon in the next couple of weeks. The course is going to be at your pace course. Go online and access it. It's a multifamily course from soup to nuts, essentially talking about from identification, market research, acquisitions, capitalizing your deal, capital raising, preparing for an institutional buy, to exit. Hopefully get the project. It's a full cycle course on multifamily. Pretty proud of that.
In terms of the ideal student, where are they in their career?
They could be someone who is getting into the business. They want to get into multifamily, or maybe they're doing something else in real estate and they want to get into multifamily, or they are already in multifamily and they just want to improve their skills. They'd like to think of their company or approach the business in a slightly different way, because we have a different approach to the business. Our approach is more build a machine that could eventually become institutionally driven. So, because that's been always our approach. We are preparing owner operators who are in the business to become better operators and better owners, sponsors that could get them to the institutional level, or prepare people who have never been in the business and help them understand the business and get into the business. Or the other audience could be investors or potential investors that are looking into the business, but they don't really want to get into the business, but they really want to understand it fully as an investor before they invest with an owner operator or sponsor. It's a really diversified set of audience, and we're probably going to give out some scholarships to young folks if they have an interest in the business. I love seeing younger generation getting in, and that's hopefully going to be part of us giving back.
That's a great answer. So let's get into the final 5, and then we can land this plane. Obviously, you've been very successful over the years, multiple companies. Congratulations again. Nevertheless, I assume that the mortgages are taken care of and the college educations are taken care of and car payments and all the things. And yet you still get up in the morning on Monday and go to work with hair on fire, so to speak. I'm curious, what's that drive? What's your purpose?
Building businesses is a really interesting experience. It's almost like raising kids. Your work is never done, but you have to build your business to the stage where you feel really proud of the product. And for me, that is somewhat of a continuous work. I don't think the time I stop working on something and stop pursuing growing a company, either this company or the next company, is probably when I'm like, 90 years old, and I probably can't even see straight. There's no reason why I can't continue to work that way. For me, as cheesy as that sound, I really am. I build my business, especially Peak 15. We're building Peak 15 for the next generation. Meaning I'm building Peak 15, not just for me. I'm building Peak 15 for the young partners I have now in the business who are hopefully going to be leading the business and taking over my role in a few years. And then hopefully their families, and hopefully we can create a product or a company that we can all be proud of that can be passed along. And in order to do that requires work. Now, I can't just be content with what you just described of, the car is paid for, the house is paid for, the bills are paid for. Therefore, I'm okay. I'm content. Contentment is very elusive when you're an entrepreneur.
Indeed. Yeah. What do you mean never? I've never retired.
What does that look like? Me spending 8 hours a day on a golf course? That sounds terrible for me.
It's agonizing. Yeah. When I left Silicon Valley, I took a few months off. 2 weeks in, I'm following my wife around the grocery store, and she's like, you need to go find something else to do. I'm like, okay, done. Accelerated our plans and off we went. I can't ever imagine turning it off. Even if I'm 90, as long as I know my own name and I can still do math in my head accurately, I don't see me stopping.
Yeah, exactly. That's what I'm saying. Unless I get to the stage where my grandkids are feeding me dog food, then that's probably when I could.
Hopefully that never happens. But so you've mentioned mentoring and how you really get a lot out of that. I think it warms your soul. And so I'm curious about the mentors you've had in your life. What's the best advice you ever got and who gave it to you?
Gosh, a couple of different pieces of advice. One of my really early mentors have told me I broke my teeth in industry in finance and in investment and finance at a brokerage shop like Morgan Stanley and Royal Bank of Canada. I was an equity trader there, and That's how I got started in investment. And then from there, broke off into establishing my first firm in Boston. One of my earliest mentors from that era have always told me, don't worry about what the market is doing. The market is going to do whatever it's going to do. As long as you're in the market and you're putting your best foot forward every single day, you're never going to have to worry about what the market is doing because you're in it. You're always in it. And you are going to find your either exits or entry into deals just because you are in the market and you have the pulse on a day-to-day basis.
Yep.
And people are going to see that and they're going to respect that. And you're eventually going to be totally fine. So that is the first piece of advice that I always tell people. Don't worry what the market is doing. The market is going to do whatever it's going to do. It's going to go up. It's going to go down. There's going to be pressures. There's going to be some things coming into favor. There's going to be some things out of favor, but just be in the market and focus on what you do best. Stick to your sort of ethos that you know in your heart that you can work on, and the deals will show themselves. You just have to be ready when they do show themselves. But you can't be ready when you say, I'm just going to take a step off. I'm going to take my foot off the pedal and just take a year off the market. No, then you're going to miss out. Yep. So that's the first piece of advice that an early mentor told me. And my second piece of advice that another mentor, which is my brother, actually, my older brother, we ran together the previous company to P15. Prior to me joining him, I'm doing Mac Venture Partners. He was probably someone I looked up for from an entrepreneurial standpoint because he was the first entrepreneur my dad was the first entrepreneur, and then my brother, because he just always finds ways to he got into technology. He had 3-4 different kinds of businesses before we got into real estate. His early advice to me was always underwrite for the worst. Yep. You'll always be okay. If you always underwrite for the worst, prepare for the worst, but expect the best. Obviously, but always prepare for the worst. Don't ever expect the best. Always underwrite for the worst case scenario. Yeah. This way, when you get to the market conditions where it's completely against you, you're fine because you already expected that you're going to have a crap sandwich at some point. That's where you underwrote. If you underwrote a crap sandwich, then once you get it, you're like, oh, yeah, I was expecting that.
When the market turns up, you're pleasantly surprised, right?
That's right. It's the old adage of under promise and over deliver. That's what we try to do all the time. And so these are the two best pieces of advice I've gotten from mentors.
Both excellent. I fundamentally believe that we learn more from our mistakes than we do from our successes. I'm curious about a decision you'd like to have back over the years that didn't go your way. I won't talk about that you'd love to have back. And how'd you handle it? What'd you do?
Oh, man. Yeah. That is terrible. Yeah. I wouldn't be an entrepreneur if I didn't say I had so many bad decisions, but I also had a lot of bad decisions and bad choices that unfortunately we learn from. Hopefully we learn from. That's the good part. That's the positive part about them. I would give an example of even a recent deal that we tried to do a couple of years ago. The mistake that I made in that deal is that I didn't listen to my gut. One part of our criteria now in our fund, when we fund sponsors, developers, when we invest with them or co-invest with them, is above and beyond the underwriting, above and beyond the numbers, above and beyond the bricks and mortars of the property that we're getting into. There has to be a human element that we're comfortable with. So obviously we underwrite the sponsors themselves. We have to know their experience, their knowledge, what kind of deals they've done in that market and all that kind of stuff. But after all of that, you got to, at the end of the day, be comfortable with the person that you are dealing with. That is something that is hugely important to me and will always be important to me. And that's something that we started to inculcate in the company culture on a day-to-day basis. I don't sign off on any deals unless one of the principals have met in person with the other principals of the company that we're investing with or co-investing with. In that instance, I did not go with my gut. My gut actually told me in that deal that I just mentioned, my gut told me not to invest with him. There's something off about this particular gentleman and I couldn't put my fingers on it. I even took up the phone and called my partner, Francisco, and I said, man, like, I just don't, something about him just doesn't sit well with me. But the deal is great. The deal is fantastic. I get it. I understand the deal is fantastic, but I don't like him as an individual. And I was right. Unfortunately, the deal didn't materialize. Thank God it didn't materialize. But we ended up losing a little bit of deposit money on a deal because it went sideways because of him. We had a couple of other things that went sideways on us. The seller didn't disclose certain things and there were some value loss that we couldn't make up. But at the end of the day, that was a large part of it. And that's something that is a huge lesson for me. And that is something that we inculcate today in our culture, that we have to have a comfort with the human being that we're dealing with.
You're getting married, right?
You are married for the next 3 to 5 years, and there are no room for egos or childish games or anything like that. And if somebody's doing that, then you're not going to have a good time with them for the next 3 to 5 years.
And when you're dating, so to speak, to extend the metaphor, everybody's on their best behavior. So if your radar's going off then, what happens if the market changes or the deal changes in some way? You got to know that you're in cahoots with somebody that you get along with and can work with, right?
That's right. Yeah, absolutely. Regardless of the numbers, we always say a good deal can go sideways really fast with a bad partner, but even a bad deal can be saved and become a success with a good partner.
Amen to
Because
that.
you can collaborate, you can find ways, but with a bad partner, man, forget it. Right.
I'm curious about how you take in information and how you continue to learn. Tell me about the book that's on your nightstand, either virtual or otherwise, and what authors are you paying attention to?
Books on my nightstand. My nightstand is always, I'm always told to pare down the books that are on my nightstand because they overflow and I have to sometimes add them to the library and take some books off the nightstand. So I'm very ADD. So in order for me to really use the ADD to my advantage, I read multiple books at the same time instead of just one book. Because sometimes I get bored by reading one book. I read 20, 30 pages, 50 pages. I put it down and start another book and read another 20, 30 pages and go back to another book. Right now, I'm actually rereading a couple of books that I've read in the past, but I like them and I wanted to refresh my mind about them. I'm rereading, you may have known it, it's called Atomic Habits. I'm sure you know that book.
There, yeah.
It's one of my favorite books, and I'm rereading that because we can all use some brushing up on our day-to-day habits that we can do to be successful on a day-to-day basis. That's one book I'm rereading. I am reading a book which I meant to read for a long time called The Startup. It's Reid Hoffman, who is the founder of LinkedIn. Reading that book as well on my nightstand. I have another book I'm reading called How I'm Doing. I forgot the name of the author, but it's essentially 40 conversations with yourself that you can have, daily conversations that you can have with yourself. It's called How Am I Doing? And it's one of those contemplative kind of books that more sort of philosophical in nature, but really important to have these conversations with ourselves. I try to do meditation on a day-to-day basis. I try to get up in the morning and write down my intentions for the day or for the week. And that really helps me stay focused and more zen in my day. I suppose it doesn't always work. I'm not saying it's a perfect system, but it's something we got to try.
At the very least, you're stacking the deck in your favor because as a fellow ADHD person, I've got a plan every morning when I walk in, but it's the old Mike Tyson thing, right? The right cross comes and then the day goes like this. But at least if you've got those, I do the big three, right? My focus is on, I'm going to get these three really important things done that are moving me towards longer term goals before I leave tonight, no matter what. And so I plan them. And when the plan goes if it goes according to plan, I'm done at lunchtime. Fantastic. Now I can focus on my team, the company, whatever else, partners, whatever. But occasionally I'm there at 7, 8 o'clock because I had a fire to fight. So I feel for you. One of the other things that I'm always interested in is how, I suspect I know the answer given on how you answered something else, but I'm curious how you define success in your life.
Success is taking care of the people you love around you and making them a success. If you are empowering others that are in your circle, and it's not just family, it's people that you surround yourself with that are part of your life on a day-to-day basis or part of your business. If you are a source of that empowerment for them and help them elevate themselves and at some point in the future, help them get to their hopes and dreams and leave that as somewhat of a legacy, whether they're your kids or your partners, maybe your mentees, that to me is always a huge success. Don't get me wrong. I'm not just a benevolent organization here. So we are doggedly pursuing success and profits on a day-to-day basis.
There's a value exchange there.
There's a value exchange for sure. But that to me is success. Success is when someone hears your name or hear your company name, they say, oh my goodness, he's a great guy, or I'd love to do business with them, or they're fantastic. I've never dealt with anybody there that I didn't like. That's success. That to me is success. The trappings of a luxurious life, that's nothing. That's stuff. Stuff comes and goes all the time. Stuff means nothing.
I've yet to meet somebody who is approaching the latter part of their life and thinking, God, I wish I had more stuff.
Exactly. You never hear that. When you talk to someone in the sojourn of their lives, you'll always hear, God, I wish I had more time with my kids or my grandkids, or I wish I spent better time with my wife or husband. I wish I traveled more. I wish I experienced the world. I wish I provided better experiences for my family or whatever it might be. That's the definition of success. If you get to that, hopefully that stage of life, I'm not in a hurry to get there, but when I get to that stage of life, I hope that I can have fulfillment in those answers.
So when you're not talking about real estate, what do you enjoy doing? How do you spend your free time?
I am an avid outdoorsman, a law of the outdoors in all its shapes and forms, but more importantly, the outdoors that involves forests and mountains. The name of my company isn't to the biggest mountain in the world. So that's what Peak 15 is. Peak 15 is the name of Mount Everest before it used to be called Mount Everest. So I love anything outdoors. I'm a hiker, a trail runner, a mountain biker, camper. Point me to a forest and a mountain and I'm there. And the beaches are okay. I spend a couple of days at the beach and I'm bored. There's really not much for me to, I'm not a beach guy. I see the value of the beach for a couple of days, but then after that, I'm done. I'm more mountains, forests, get me among the trees and I'm in my happy place. So I try to do that on a regular basis as much as I can.
Excellent. John, if somebody wants to learn more about you or Peak 15 or your upcoming course, I know you're speaking at several events coming up in the fall. What's the best way to learn more about you and reach you?
Yeah, absolutely. We're also still accepting investors in our fund, by the way. So just wanted to throw that plug in. People can find me online. They can email me directly, azar@peak15cap.com, AZAR at peak as in mountain peak, 15 cap as in capital.com. So azar@peak15cap.com. Or go to our website at peak15cap.com. I'm also on Instagram. I'm a huge user of LinkedIn. LinkedIn is probably the number one platform I use on a day-to-day basis. I don't have Facebook and Instagram on my phone. I only have LinkedIn on my phone. The only way that I interact on somewhat of social media, I suppose you could say, is LinkedIn. I'm not much of a social media hound. That's what our marketing folks do.
Be a producer of social media, not a consumer. You'll be happy.
That's right. Yeah, that pretty much sounds like me. People ask me, we sent you a message on Instagram. Why don't you get it? I'm like, because I don't have Instagram. You probably saw a post from one of my marketing guys that did a post for me. That doesn't mean I'm always watching my Instagram. Yeah.
John, thank you so much for your time today. It's really been a pleasure to speak with you. And I wish you continued good fortune. And like I said, next time I'm in the Carolinas, I will definitely look you up and we can grab lunch or grab a cup of coffee or something.
Sounds amazing. Thank you.
This has been the Real Estate Underground podcast. Thank you so much for listening. Don't forget to rate, review, and subscribe. It helps us grow. Until next time, happy investing.